Recently, I was speaking with clients who had just visited their finance broker, and during that meeting, the broker raised assessment rates, and the clients weren't exactly sure what assessment rate was. So I thought I'd put this video together just to run through the difference between assessment rates, standard variable rates, and why an assessment rate exists in the first place and what it's used for. Okay, so we're looking at three different things. Firstly, the cash rate, RBA's cash rate. Secondly, is the lender's standard variable rate on a particular product. Then the third one is the assessment rate. So most of us are aware that majority of lenders buy their money from the RBA. So if the RBA is selling their money, the cash rate say is 1%, then the lenders will add typically 2 to 3% to that rate. So that's to cover their costs and obviously to make a profit. So the lenders are in the business of selling money. So they sell the money to the borrowers, to us, and they apply that markup, if you like, to again cover costs and to make a profit. However, from there, they also have there are lending responsibilities. So what they need to do is be able to assess our ability to repay or make those repayments and see those repayments out by adding another buffer that is again referred to as assessment rate, benchmark rate. Today I'm referring to as an assessment rate. So the lenders will assess our ability to repay the debt at a higher rate than the standard variable rate or what they're selling the money to us for. So RBA cash rate, lender standard variable rate, and an assessment rate. So the assessment rate could be, again, 2 to 3% higher than the standard variable rate. So we've got a margin on the cash rate, and then we've got to form the standard variable rate, and then another margin is applied to assess our suitability or our ability to repay debt. Now, the assessment rate is applied for a couple of reasons. The main one is to ensure that if there are interest rate rises, then we're not going to be pushed into financial hardship. So if we go back to a standard variable rate of say 3%, if the lender was to assess our ability to repay the debt at 3% and then interest rates went up, then we could be in trouble and they could be in trouble as well. So that assessment rate is applied as a way of protecting us and the lender should interest rates rise. Now, APRA got involved and the government got involved around applying some further restrictions. So because the cash rate is so low and the standard variable rate is, again, the lowest it has been ever, then what they are looking to do is, without telling us how we've got to use our money, what they can do is say, well, what we want you to do, lenders, is keep that assessment rate higher. So rather than being, say, 2 to 3% higher than the standard variable rate, they can say, well, no, we want you to push that up higher. So currently, a lot of lenders are using an assessment rate of around 7%. So again, if the standard variable rate is 3%, then at 7%, they're adding a 4% buffer or assessment rate of 4% higher than the standard variable rate. So it's a way that they can slow down lending, which means they're going to slow down and put a ceiling, if you like, or a cap on household debt. So they can't tell the lenders what they're going to sell their money for, but they can certainly have an influence on how the lenders assess us. So the lending standards and the quality of lending is something that can be controlled, and lenders have to fall into place. So cash rate, standard variable rate, and assessment rate. So just because, again, rates of historical lows doesn't mean that we're going to get the money a lot easier than we were, say, 5 or 6 years ago, 10 years ago. The fact is that they're still assessing us at those older assessment rates. Now, the other thing to keep in mind is that not all lenders are the same. So what we need to make sure that we're aware of is that just because one particular lender has a certain standard variable rate, their assessment rate may be higher than another lender who has a slightly higher standard variable rate, if that makes sense. So to think or fall in the trap that all lenders are the same, then again we could be missing out on additional borrowing capacity. And from there, if you go and talk to different lenders, so let's say 3 different lenders, they all could have 3 different borrowing levels or 3 different amounts that they're willing to lend you as a borrower. So your borrowing capacity, said another way, your borrowing capacity could differ and most likely will vary from across those 3 lenders. So again, I think it's important to sit down with a broker who's experienced with investment funding, property investment funding, and then talk to them about your scenario so that they can say, well, based on what you've told me, lender A is the right option or the better option for you, and this is why, and they can show you the reasons why. And it could be borrowing capacity, it could be the particular type of employment you're in, etc. But just for today, the assessment rate is what the lenders have to apply to their serviceability calculations to ensure that they're allowing enough buffer there in case interest rates rise.